All right. Here we are. We are alive, which is a miracle.
Perfect.
Yes.
Perfect.
Hi, everybody. So, yeah, for some reason we don't have our name under, but that's okay. I don't know where it disappeared. Well, it's technical difficulties. Every time there is something that doesn't go perfect. But anyway, I'm Mary Cadero. We have Caroline Blossel, and we have a wonderful guest, Porter. I'm going to butcher that name. Shanwei?
Perfect.
Oh,
Yep.
wow. That's good.
Nailed it.
Awesome. Well, for whoever is listening to us live or people in the future, we thank you for being here. We have a really good, amazing, actually. Gosh, I forgot my words. A guest here today that we're working with him, and he is amazing in tax strategies. And I think we all need some tax strategies. Doesn't matter where we are in life, we all want to save in taxes because, in my opinion, we pay way too much taxes, don't we?
Mm-hmm.
So yeah, so that's what we have our friend here that is actually specialist in tax. So here, Caroline, why don't you just introduce him for us?
Because Porter's a man of many talents. Just also wanted to say he's been in the industry of financial strategy and planning for the past, since 2000. And then the three of us work for a company, Bright Advisor, BrightWealth. And you also have one of your own shows where you educate others on just financial strategies for better retirement income than some of the traditional methods that many of us are familiar with. But along with that, we talk to many business owners and that are always looking for ways to maximize their earnings through tax strategies. So there's one in particular that I just recently heard about, and I know Mary, you did as well. And we wanted Porter on today to share with us this particular tax strategy that is one that I'm sure a lot of people aren't familiar with. So with that, and also Porter is the proud father of 4 kids, and I'm not sure if that was one of them that just went behind you.
No, that was my sister-in-law.
That's your sister-in-law.
That's okay.
It's just to show we're all human, working from home, and family things are around us all the time. So. With that, Porter, share with us just how you learned about this strategy and tell us, just how you got into the tax strategy side of financial planning. I think that would be a great question to start with.
Yeah, so I found about this strategy first. So when my partner and I, business partner, we decided, hey, we've got a lot of clients that keep coming to us with tax problems, and that was kind of affecting our planning. Every time we would go to plan, it's like, well, I've got this tax issue, and so I don't know if I've got money for A, B, or C. And it got to the point where it's like, well, we should be able to help these people and then work with their accountants as well. And so we went and got a tax certification. We spent hundreds of hours in study. We've been to several seminars and events since then, and have rubbed shoulders with lots of tax attorneys and CPAs. And in the process of that, we were introduced, I should say, to several strategies. And one of them seemed to kind of jump to the forefront right now. And that's where we first were introduced to this particular strategy. And like anything else, it all evolves. You learn things out of necessity. It's like, well, we needed to help, and so our practice evolved into this, where now it's almost primarily we first address the tax issue, and then that frees up money for people to reinvest in different wealth strategies on top of whatever else they were planning on.
No, that's brilliant, because I remember years ago just hearing how important it is to, how can you make your things that you do in business be a tax write-off, or just a different mindset in your approach to all the things that you're doing. And a lot of that comes back to taxes, at
Yeah.
not at the end of the year, but throughout the year. What can I be doing to maximize building my business?
Yeah, I think one of the things that we wanted to jump all over was there's always, like you said, these what can I use to create tax write-offs? What expenses am I already employing that can be tax deductible? That is great. What we wanted to do was take that a step further and say, what can I use money that was already going to pay taxes, not even expenses for my business, but actual taxes, and then redeploy that money to get me discounts on, or not discounts, what's the word
Deduction.
on deductions? There we go. Get
There you
deductions
go.
on my tax return. So we're actually just redeploying money that was already going to taxes to offset those taxes.
Oh, I love that. That's so brilliant, isn't it? It's like,
Yes.
I love to say, I think we learned that from what's the guy, tax guy, that in Renatus that taught us tax.
Oh, it's, and
Yeah.
this is the
Yeah, what's
it's
his
who
name?
he learned his tax strategies from
Exactly.
as well. So tell us, Porter, who did you get started with your just learning about taxes? And he
So
has
we
his own
we dove headfirst in with Mark Kohler,
There you go.
and Mark
Mark
Kohler
Collar.
was.
Yes.
We went and talked with him personally, and we got to go to a couple of his events, and got to do some golfing with him. Not real golfing, top golf, but and so just in that general process, learned a lot. This particular strategy we learned as a byproduct of that. So, and one of the things that I always say is the same thing that Mark even says: don't beat me up. I don't know everything, right? And I will never pretend to know everything about the tax code, but I am constantly learning and willing to learn more. But what I do know, I like, and we make sure that it's very mainstream. We're not really interested in the fringe, the raise the red flag type of tax strategies. We want to do something that is right down the middle, that you can feel good about, that your accountant can feel good about. And that is one thing we also really want to do, is if we introduce a tax strategy, we want your accountant that you use to be on board with it, so that the whole team feels comfortable. And if you don't happen to have an accountant, we've got several that are familiar with these tax strategies. So
Oh, yeah.
Great. Well, you want to dive in and tell us what is it?
about this particular strategy?
Yeah, this
Sure.
particular
Yes,
strategy.
let's get the cat out of the sack.
Yeah.
Okay. All right.
Out of the
So
bag.
so there are several tax strategies that you can use, that you can deploy money that would have gone to taxes that will then offset those taxes and even make you some money. That could be anything from land easements, which people are familiar about. That could
Yes.
be rental properties. That can be opportunity zones, and maybe even restoration of historical buildings. All of those can produce you up to 2 to 4x on your money that you invest in it as a tax deduction. The one that we're most excited about currently has to do with construction equipment. So we have done lots of research and partnered with people who kind of help us with that construction equipment purchase and management. Anybody, farmers do it all the time, construction companies do it all the time. As they're approaching the end of the tax year, I'm going to buy another large piece of equipment, and that is going to help me lower my taxes. Well, the rest of us can now participate, even though we don't have a construction company or we're not farmers.
Yeah.
And the reason we can is through partners that we have formed, partnerships that we've formed, where I buy a certain amount of equipment, and that gets put into a fleet, very much like Turo or like Airbnb. And that gets put into this fleet, and that gets rented. And my job as a business owner of rental equipment now is I just have to make sure that I am watching my fleet. I'm managing it daily, and I'm maybe going and visiting one of the locations, or I'm researching new equipment that I might want to purchase in the future. I just have to do that for a set period of time each year so that I am following the law in order to get that kind of deduction. So we get the equipment and we put it into the fleet, and then we make money anywhere from 18-20% sometimes on the money that we put into this investment. So for example, if I had, let's just say I make $300,000 a year, and that could be W-2 income, that could be 1099 income, that could have been from a sale of a rental property. So I have a $300,000 capital gain, or the sale of stocks that I'm seeing a capital gain on. Any number of income streams. So let's say it's 300,000. I'm required to put 30,000 down, and that gets me $300,000 worth of equipment. The partners that we have, they will go and help us find lenders to get the $270,000 of the loan that we need for that. And now for 30,000 of my dollars, I get a $300,000 deduction that year. And so if I've made $300,000, I have zeroed out my taxable income for that year. And so what do I do with that money that I was going to pay taxes on? And to put that into perspective, I think I have a sheet here somewhere. I got rid of it. Anyway, that's about $60,000, $70,000 worth of taxes. So I'm going to put in 30. They do have closing costs, just like a rental home if I buy that. But even then, maybe I'm all in 40 grand, and I get 300,000 in deduction. So I've saved myself 20 to 30,000. What am I going to do with that 20 or 30,000? I can go put it into other wealth building activities. So that's money that normally would have gone to taxes that now I get to redeploy. That's the whole point behind this, is what can I do with that money that I was going to spend on taxes anyway? So
makes sense. So can I clarify something? If I understood you correctly. So even money that you actually do like a 1035 exchange, you know how we do that in
for real estate, like a 1031 exchange?
Like 1031. I don't know why. I know why I did 35. There was something else I was thinking that had 35. Confusing.
Life insurance.
That's it. Thank you. You see how I'm confusing myself? So the 1031 exchange, so you can use that kind of money instead of actually paying taxes on your
earnings.
Yeah, on the earnings. There is a name for it. Again, nothing comes to my head today. Capital gain. There you go.
Gain, yep.
You want to negate the capital gain because obviously nobody wants to pay capital gain, right? So you can use that money to use this strategy, right?
Mm-hmm. Absolutely. That's what. So if you didn't want to do a 1031 exchange, you mean? Absolutely. The whole point of a 1031 exchange is to avoid capital gain.
Exactly.
Avoid taxes. Exactly. Mm-hmm. So if you said, well, and the thing with 1031 exchange is maybe somebody says, I started at $100,000 basis purchase of this home, and now it's worth $500,000. They 1031 it into another one. They have to start at $500,000.
Right.
They can't, or buy a couple properties up to $500,000. Now maybe they go to $1 million, and now it's like maybe that their 1031 basis is now $1.5 million, and they're just like, if I sell this property and I make $1.5 million, my basis was $100,000. So now I've got a tax of $1.4 million, and I don't necessarily want to find a $1.5 million piece of property or 6 properties to equal that. It's just I want to retire, or who knows, and they just don't want to do a 1031 exchange, or they want to lower that basis again. They can then use this equipment to offset that gain. So let's say they've got $1 million. I'll make it nice, easy math. $1 million that they've gotten this gain. So the capital gain on that would be, if they sold it, it would be roughly 20% once it passes a certain threshold. And if it does that, then they're going to add Obamacare of 3.8% to do that. So you're looking at around 23.8%, $238,000. So for $100,000, they could buy equipment, make 18% on that 100,000, walk with the extra 138,000, and now they could purchase a property with a basis of whatever it is, 100 grand again, 200,000, whatever. They don't have to find one at $1 million. So there's a lot of reasons that they could do equipment, or they could just say, you know what, I'm going to take the $1 million that I was going to use for that, and I'll just buy equipment with it, all $1 million, you know. And now they're making, you know, 15 to 18% on that kind of a purchase, and they don't have renters to deal with, they don't have hot water heaters to deal with, or carpet or anything like that, and they're making all this money every single year, same amount. We have several real estate clients who are starting to say, hey, maybe I want to do this instead of 1031 exchanges.
Yeah.
So tell us a little bit about, do you see any downsides of, or, you know, everyone's always wanted to, okay, we've talked about the pros. Are there any cons in this strategy that would need to be taken into consideration?
Yeah, I don't know if it's a con. It's just reality. Just the same thing with 1031 exchanges. You're given an opportunity to kick the can down the road on paying that tax. Eventually, taxes come due, right? So it's the same concept with this. One of the realities of it is what I'll call it is that at the end of a 5 or 6 year term of doing this, you're going to get your money back that you put into it plus half of the loan. You know, then that's going to be called a depreciation recapture. So if I've depreciated $1 million, after 5 years, I might have 550 left on the loan, and they're going to give me my 100,000 back. So maybe $650,000 recapture. That's the reality of it. I have choices at that point. So if you want to talk about some of the downsides, maybe people think, well, this is a hassle. I have to go through all this again. To me, it's a huge win still, because I could have paid taxes on $1 million, but now I can pay recapture taxes, which is generally a lower tax rate, on $650,000. That's a big difference.
Mm-hmm.
Or I could re-up and do the equipment again, just like a 1031 exchange.
Mm-hmm.
Only difference is I don't have to go up each time on my basis. I can just do the same amount.
Gotcha.
Or my recapture amount is $650,000, so I could just buy $650,000 worth of equipment. So it shrinks that recapture, and so then 5 years from then it should be close to half of that. So you can continue to shrink that.
Mm-hmm.
That's maybe one of the downsides. Is what do I do when those terms come up? Same thing happens with real estate. What do I do when I want to sell that property, or I'm done with this kind of a strategy? Or if I want to take it out of Airbnb, or I'm done with these Turo cars. I gotta sell them.
Mm-hmm.
There's no way to escape these kinds of things. We want that. We want to be able to escape taxes.
Oh yeah.
You know, the IRS is saying, fine, we'll give you these deductions because you're starting this business. We're all about business, right? But you just have to understand that the reality is that you can shrink that. You can't really escape that. So that's maybe something to consider. Other things to consider is that what happens in the industry of heavy machinery? How long can this sustain itself?
Gotcha.
For the foreseeable future, it looks really great, just like real estate. But you're going to have maybe some ups and downs potentially, just like any type of investment or industry. So you got to know what you're getting into, and if you know, then it's fine.
Mm-hmm. Well, like everything else, there's somewhat of a little bit of risk. So,
sure,
there is really no gain with you if you don't risking anything. That's the reality.
You can do calculated risks, right?
Exactly.
Risks.
It is absolutely. So when you're saying there is upside down, so I think it's really potential that sometime if it's like goes down, maybe you make less than what we're talking about. I mean, that's what you're thinking about when you
maybe there's just less utilization of the fleet or the equipment, so maybe you aren't able to get the same types of returns. Yeah.
Okay.
Right now, the way that it stands with the math behind it all is if the fleet as a whole, not even mine, my equipment could sit idle for a month or two at a time, but it's part of a bigger fleet. It's like the NFL. The NFL is a whole group. So you might get one team in Tampa Bay, for example, that doesn't make as much money as the team in New York, but the whole entirety of the league together pools their money together, and then they split that. Well, it's the same concept with this. My equipment is going into a fleet, and if the fleet is being rented about 45% of the time, then I'm going to make my money on my equipment, that 18%, and I'm going to make enough to cover the loan. So the risk is well, if the industry is really suppressed and we're not getting a lot of rental, as long as it's above 45%, the actual number is 48, but I didn't want to get too technical. If it's above that, we're good.
You're good.
And currently for the last 10 years, it's been about 70 to 80% utilization.
Wow.
So as long as you understand that that is a possibility, then you know that if we start to get to those points, maybe you sell your equipment and get out of it and just pay your recapture and just not risk having to just pay the loan all the time.
Gotcha.
So yeah, there's risks you take on there, but they're very low. I mean, they haven't missed these kind of payouts to us for going on 10 straight years.
Wow.
So yeah.
And you're also saying that monthly, are you paid monthly, the return on your investment, or who's ultimately responsible for that payment of the remaining balance on that loan?
Yeah, so I'm ultimately responsible, but I get a deposit on the rents from the equipment every single month at the same time. And then the bank takes out the loan portion and I'm left with the rest. So at the end of the year, it's 18%. So it's simple interest. It's not like going to compound the following year, but it'll be 18% every single year that I'm left with.
Wow. I like that.
Yeah.
Yeah, it's really a great strategy. I mean, maybe I'm somebody who's got debt that I need to pay off, but I still owe taxes. So why don't I just take the money I would have paid in taxes, do this, then take the money I saved in taxes and pay off some debt? That's one way to pay off debt. Or maybe I've got other investment strategies I can borrow from. Go get some equipment, then funnel that money back in. There's just so many things you can do with it because it's such a large deduction. I could use other strategies and get like a 5x, or 4x on my money and still do that kind of stuff. But for the time being, this is a large deduction.
And so the original kind of time commitment, if you were to choose to do this, did you say it was originally, it starts out at a 5-year commitment?
Yeah. So they just recently told us this year that they could push it to 6 years. And I think that has to do with how the equipment is being utilized. So like if it's still perfectly functional, and I mean the equipment shelf life is about 8 to 12 years.
Okay, that's what I was going to ask. What's the
I mean, I could keep it. I could just say, all right, we're done with this term. But the equipment company who's renting it, they have first right to, like, as part of our contract, they say, well, we would like to purchase it from you in 5 years, and then they just keep it in their fleet for another 5, and then it dies, or they keep it in their fleet for 3, and then they sell it to some other country that might need more equipment, and then they replace it with new equipment. So anytime I'm buying equipment, like this year, mine is the newest. It's a 2024 brand new piece of equipment. Next year it'll be 2025. But then when they buy it back from me, it's very profitable for these companies. So
sure, otherwise they wouldn't do it.
Yeah.
I remember looking with you the other day at your fleet, and just it shows you what's being utilized, which ones are being rented out currently. What's in your fleet?
Yeah.
So I have mostly lifts. Like other clients of mine, they have excavators and dirt movers, but I have some scissor lifts. I've got a boom lift, a 50-foot boom lift. That thing cost about $125,000, which is it's just really cool to me. I have a scissor lift, and then I've got just a really industrial strength size forklift for heavy duty things. So
Yeah.
I got a
I'm about
warehouse
to
or
buy
something
more.
like that.
Yeah,
Oh.
I'm about to buy a couple more pieces here soon because I want to, and I have I save my money. So now anytime I get paid, I just put 10% aside for taxes. And once it reaches a certain threshold, I'm like, well, I might as well just put it to work. So I'm going to buy some more. And I'm going to ask for some excavators.
Oh, awesome. Yeah,
Dirt
that's
diggers.
cool.
I know I have 6 sons, so they loved it when my neighbors were using an excavator to put in a basement auxiliary apartment. And then I've used the scissor lift. My daughter is a muralist, and we've had to do some really high painting, and it's so much easier to have a scissor lift than scaffolding on wheels that you're trying to move around. It's way more
100%.
Yeah. So
I have another question for you, Porter. You, for this strategy, you can use some retirement money that you can use those, right, to invest.
Yes. Yeah.
Like,
You
for example, like
can.
old 401k that's sitting there not doing anything. You can direct
So no, that's a little bit different, actually. Using qualified money
qualify. Yeah.
is it's a little gray,
Okay.
So you're not going to get the same kind of a benefit. You can't use that for the tax benefit.
Gotcha.
So you could possibly use that just as an investment, but you're not going to get the tax break.
Okay. Yeah, it makes sense because it's not taxed.
Yeah, it's already in a tax advantage vehicle.
Okay. So what about
You can
Roth?
use life insurance, however.
Okay. Well, we know that life insurance is you can borrow against what you have.
Right.
And
You could take a withdrawal from your qualified vehicle, and just buy the equipment, and now it will be outside. You're going to just pay a penalty in tax, or if you're above 59.5, you won't pay a penalty, but you'll pay tax. So you could absolutely do that.
Okay.
Depending on why you're doing it.
Yeah.
Well, I was going to say it's one of the reasons it's helpful to just talk through strategies because everyone's situation is different. People's interests, like you and I, Porter, were talking to a client and he loved the idea of the heavy machinery because he's in seismic reconstructions in California. So that appealed to him because it's part of his industry he's been in for the last little while. So it's great to just hear what else is out there because most people are familiar with the ones you started off with the 1031 exchanges, the opportunity zones in communities that are taking revitalizing them.
Yeah.
And that is one that a lot of times real estate investors look at, those opportunity zones for the extra incentives for developing those and bringing.
Those are great.
Yeah, those are great. So this is just another one. So so if people are interested in learning more about this tax strategy, Porter, where do they go to find you? I mean,
you can go to our website at BrightAdvisor.com. They could reach out to you guys, and you guys could put them in contact with us. Mm-hmm. My email, they could email me. I don't know if you want me to say it or if you just post it, but
we can actually add it.
In the description, but Porter at BrightAdvisor.com. We're available to help. We have clients doing millions and millions of dollars into this. We just finished with a client who bought $15 million worth of this equipment. They generated a $9 million loss for this year, which losses are great for business because they don't expire. You can pass that forward. She's going to be making over $500,000 a year just in interest alone from the equipment. It's just a really, really awesome thing. Yeah. And we even have mega deals issues. Like it is so broad reaching. Like we have somebody we might, this is just early on, but potentially we've got people who sell apartment complexes or people who sell office buildings. And now you're talking 100, 200, 300 million dollar gains. And how can you offset that in 1 year? Right now, we can use bonus depreciation with equipment. And bonus depreciation is going down each year. So now's the time. Take advantage of it. So
Yes.
Yeah. Fantastic.
High incomer. Definitely.
Yep.
So
yeah, well, and it's just, I don't think this is an area most people are thinking about with just having such a big bucket for those deductions for the things that we've talked about today. I just want to see if there's one more question.
there was.
Yeah, I think that I'm just looking at the questions I have for you today, and it looks like we answered all of them. I just think it's great to know that this could fit a variety of situations for our clients that are just really looking at what's going to be happening in my business this year, especially if you are going to be selling. And how can I just kind of start learning about it now and see how this might fit into my situation that I'm in right now, because it's there's a lot to learn, but it's not highly complex. There is some bit of a time commitment with it because
certainly
now
time sensitive at this point of the year.
Yeah, right. But I appreciate your time today, Porter, and look forward to any of those who are listening to this and looking at some possibilities for the future, and that it's one that's really worth considering and learning more about. So thank you for your time.
Thank you.
And
Thanks for having me.
Yeah, thank you, Porter. And I just wanted to add that it's amazing. It's great strategy, not only for investors and entrepreneurs, even people high incomer and that makes a lot of money, in W-2, and they pay so much taxes. I think it's awesome. To mitigate that. So, well, thank you for your time. Thank you for being here.
Yep,
you're welcome.
Appreciate it.
Glad to be here.
All right.
Okay.
So,
bye.
Bye.
Bye. All right. What can I